DFIN Markets version 1.0 Advisory Insight Report, September 23rd, 2025. Market regime identified. Stable volatility, contracting liquidity. Forecast horizon 4 weeks. Overall confidence 80%. DFIN Markets detects that the current market environment is characterized by persistently elevated volatility and system-wide liquidity contraction. This combination typically favors defensive assets like long-duration bonds and cash, while creating headwinds for equities, particularly growth-sensitive sectors like emerging markets. The system projects this regime to hold firmly for the next 2 weeks, with a high probability of a significant shift in the yield curve dynamics in weeks 3 through 4. Detailed breakdown of signals. 1. Volatility basin. High confidence, 82%. Signal, underweight U.S. large cap equities. Interpretation, the VIX pattern shows a stable, elevated volatility regime. This is not a short-term spike, but a persistent condition. Historically, such environments compress equity valuations and increase risk premiums, making large cap stocks less attractive. Investors should reduce exposure or hedge equity positions. 2. Liquidity basin. Very high confidence, 91%. Signal, overweight United States cash. Interpretation, the Federal Reserve's balance sheet is contracting and reverse repo activity is minimal. This indicates a reduction of liquidity in the financial system. Tighter liquidity often leads to higher funding costs and lower market liquidity, favoring cash and cash equivalents as safe haven assets. 3. Yield curve basin. High confidence, 76%. Signal, overweight U.S. Treasury 10-year bonds. Interpretation, the yield curve is flattening, 2S10S spread, equaling 0.54%. DFIN projects this trend to continue with a warning of a potential accelerated flattening or inversion in weeks 3 through 4. A flattening curve suggests slowing growth expectations and is typically positive for long-duration government bonds. Number 4. Economic growth basin. Moderate confidence, 69%. Signal, underweight emerging markets equity. Interpretation, global GDP growth, while positive, shows signs of fragility. Emerging markets are more sensitive to global growth fluctuations and are particularly vulnerable in an environment of contracting dollar liquidity and elevated volatility. This asset class carries elevated risk under the current regime. Key risk and opportunity. Near term, 1 to 2 weeks. The current regime is stable. The highest confidence signals, cash, treasuries, are the safest bets. Forward-looking risks, weeks 3 to 4. The system flags a high probability of regime shift originating from the yield curve. This could signal a transition toward a more pronounced risk-off environment. Portfolios should be positioned defensively to weather a potential spike in volatility or a growth scare. Recommended asset allocation tilt. Asset class, U.S. large cap. DFIN signal, underweight. Rationale, persistent high volatility compresses valuations. Asset class, U.S. Treasury 10-year. DFIN signal, overweight. Rationale, flattening yield curve favors long duration bonds. Asset class, emerging markets. DFIN signal, underweight. Rationale, high sensitivity to fragile global growth and liquidity. Asset class, U.S. dollar cash. DFIN signal, overweight. Rationale, defense haven during systemic liquidity contraction. Conclusion: DFIN Markets version 1.0 identifies a defensive market regime that is likely to persist. The primary recommendation is to increase portfolio defensiveness by raising cash and treasury allocations while reducing exposure to equities, especially in growth sensitive areas. The system will monitor for confirmation of the projected yield curve shift in the coming weeks and provide updated guidance. This analysis is generated automatically by the DFIN engine based on detected fractal patterns in market macro data.